Well, inflation has fallen dramatically in the December quarter, there's no doubt, down from 5.4% to 4.1% year on year. Now, that means the inflation rate is now below the cash rate. That is very important. It's the first time since June 2020. Even more encouraging, the monthly inflation gauge for the year to December shows the annual rate at 3.4%, almost within touching distance of the RBA's preferred 2 to 3% band. Now, during the quarter, housing costs come down from their highs, which the Bureau of Statistics attributes to the increase in the Commonwealth rental assistance. Electricity prices have also eased after the introduction of the government's Energy Bill Relief Fund. And also today, the Australian Energy Regulator, of course, noted lower electricity and gas prices because of more favourable weather conditions compared with the previous year. But other items continue to rise. Alcohol and tobacco higher because of the twice-yearly inflation-linked increase to excise. The spate of natural disasters triggered the biggest rise to insurance premiums since 2001. Here's the Treasurer, Jim Chalmers, saying the fight against inflation is not yet over.
Now, despite the challenges and the pressures coming at us from around the world and from around the country, whether it's global economic uncertainty or heavy weather, whether it is this inflation challenge and the impact of recent interest rate rises, we do face the period ahead from a position of genuine economic strength. If you think about 2024, what we're seeing here is inflation is slowing, real wages is growing, and from the 1st of July we will see tax cuts flowing. This is not mission accomplished, but it's really welcome and it's really encouraging progress, and it shows why Labor's responsible economic management, including our cost of living tax cut for Middle Australia, has been and will be so important.
Now, you heard Ed talk about the immediate impact on the share market with the expectation of interest rate cuts later this year. So we put together some quotes from key economists and their views. Sean Langcake from Oxford Economics says, with cost of living measures due to roll off and underlying inflation still above target, we don't expect to see rate cuts until late 2024. David Bassanese from Beta Shares says it's consistent with the RBA now remaining firmly on hold for the first half of this year, with 2 rate cuts expected in the second half of the year. Stephen Smith from Deloitte Access Economics says the RBA's hawkishness means it will not be in a hurry to cut interest rates. The next move in interest rates will be a cut in September 2024 this year. Gareth Aird from the Commonwealth Bank says we have 75 basis points of rate cuts in our profile in late 2024, 3 rate cuts, and a further 75 basis points of easing in the first half of 2025 to take the cash rate back to 2.85%. And finally, Westpac's Lucy Ellis, of course, the former head of economics at the Reserve Bank, said we continue to expect September as the most likely date for the initial rate cut in this cycle. So let's bring in Deanna Mousina, who is the Deputy Chief Economist at the AMP. Deanna, always good to speak with you about this. I mean, was there much of a surprise in this today for you?
Well, we were expecting a lower inflation print than the market, but even I was surprised by the weakness in that headline number, and also on the monthly CPI. I think the monthly CPI can actually tell us a bit more at the moment because it shows a bit more of the current trend for the month, which is a good forward-looking indicator for inflation later this year. In our view, we think inflation is actually going to be below the 3% target band by the time we reach the end of this year. So I think that the RBA should be more or less on track to cut interest rates, we think, by June.
So in other words, the argument here is that the government, the Reserve Bank, have done a good job in manufacturing the soft landing. We heard about the narrow path, and the narrow path could have been that we tipped off into the abyss of a recession, but it hasn't happened. The employment's remained relatively full, and it would seem, therefore, that Australia's economy has dodged the worst of this economic downturn.
Well, I think the RBA, the government, have obviously something to do with the weakness, with the drop in inflation that we've seen since its highs in 2022. But there are also some more of the global pressures that have come off. So all of those supply chain issues that we had during the pandemic, which led to a big increase in commodity prices and supply chain costs, that was a global issue. That had nothing to do with the RBA or the government. A lot of the electricity and utility price rises were down to some domestic factors around the supply. That also has now passed through. So some of it is down to policy, but also some of it is just down to the global pressures that Australia is under in the inflationary environment. I think the RBA still probably wants to sound a bit tough on inflation. It doesn't want to completely give away its tightening bias just yet, because there is still the risk that you could see a renewed increase in inflation. We are currently seeing that there's been a bit of an increase in container and shipping costs because of the situation in the Middle East. That could lead to some inflationary pressures. And the stage 3 tax cuts, which start from the 1st of July, could also lead to an increase in consumer spending. There are still some risks on the inflation horizon, but I think that the overall trend for this year will be lower price growth in Australia.
OK, there are consequences where you spoke there about the fact that now you've got an inflation rate which is under the cash rate. That takes enormous pressure off the Reserve Bank because you've actually got real interest rates now for the first time falling. The second issue is going to be wages, because now you've got real wages rising. Wages are rising much faster than inflation. So therefore, workers are going to start going forwards rather than backwards compared with their costs.
There is that risk that consumer spending has a bit of a resurgence because real wages growth is now rising. However, the one big difference from this year compared to last year is what's happening in the labour market. Last year, the labour market was in an extremely strong position. Household earnings growth went up from higher income from working. But this year, we think the unemployment rate's going to go much higher. It's currently at 3.9%. We think it's probably headed to about 4.5% by the middle of this year. I mean, we haven't had that unemployment rate for about 4 years now. That's going to put additional pressure on households. And let's also not forget that there is this cumulative impact of those rising interest rates. Housing interest, payments as a share of income are rising to around a record high right now. So that lagged impact from rate hikes will really start to hurt consumers who have a mortgage this year. So I am still worried about the outlook for consumers, particularly the first 6 months of this year.
OK, so we heard all those forecasts from a range of economists there. Many of them seem to gravitate around the second half of the year, and particularly September. What's your own view in terms of when we get the first rate cut from the Reserve Bank?
We see it coming a bit sooner. So we see the first rate cut from about June, which is also the time when we think we'll see the peak period of weakness in the economy, low rates of GDP growth, that increase in the unemployment rate to 4.5%, some declines in home prices as well. And we think that the inflation environment will allow the RBA to cut interest rates by then. We also think some of the other central banks around the world will be cutting by then, like the Federal Reserve. And ultimately, I think that will give the RBA the room that it needs to cut rates. We have about 3 rate cuts expected for this year, so the cash rate ending the year at about 3.6%.
Tell you what, Deanna, great to have you on the program today. Many thanks for your time. 3 rate cuts this year. Appreciate your time.
Thank you.